about 5 years. And I'd like to introduce exactly what SCORE is to you. As you can see on the screen, we are a nonprofit organization dedicated to helping small businesses get off the ground, grow, and achieve their goals through mentoring and education. We've been doing this for more than 50 years. We are a national organization. There are about 240 chapters around the country with around 10,000 volunteers, all focused on helping people either start new businesses, expand their existing business, or fix problems in the businesses that they have. Our mission is to foster vibrant small business communities through mentoring and education. We aim to give every person the support they need to thrive as a small business owner. And that's really the backbone of our organization. What do we do for mentoring? Well, we do face-to-face mentoring and we do remote mentoring, either by email, video, telephone, however it works for you. Texting, if it's just a quick question or and a quick answer, we do all of that for you. Workshops and seminars, business startup, business planning, marketing, finance, many others. We do customized webinars and seminars for community partners. And we also will provide a board of advisors if you have an organization that needs help and you need more than one person to kind of direct you where you need to go. There are few disciplines, business disciplines, that SCORE cannot help you with. If we can't find somebody within our own chapter to help you, and we have over 90 people in our chapter focused on helping you, we can find people in other chapters to assist you with your needs. As I said, we have about 10,000 volunteers, and most important, we do everything at no charge. This webinar is free. Your mentoring is free. There's no charge for any of it. We get about a quarter of our funding from the Small Business Administration and some local generous sponsors, and that's how we operate our chapter. This is a view of our website, and there's a tremendous amount of information on this website. As you can see in the lower right, request free local mentoring, register for a live webinar, volunteer with SCORE if you want to do that as well. We can work with you in Spanish. We have other features on here. The most important thing is the resources that we have in the Browse the Library link. You click on that. We've got tremendous resources focused on local business on our website. It's really helpful to you how to find funding, how to find legal help, how to find accounting help. It's a plethora of different information that every business owner needs to know. Finally, on this page, please note that it says SCORE named, SCORE Cleveland was named the National Chapter of the Year for 2022. We're very proud of that. Of the 240 chapters, we were the top chapter in 2022. Frankly, we think that we're the top chapter in 2023, but they haven't announced that yet. So hopefully, we'll be there as well. Okay. And now I'm turning it over to
me,
Chrisanna.
Welcome. Thank you for joining us this evening. We are going to maybe jump back a couple slides, John. Excuse me, I am getting over a cold, so my voice is a little iffy. But we're going to start today's session talking about how to make more money in your business. And in order to do that, we're going to want to look at things in your business, money coming in, money going out. We're going to go over some financial vocabulary. Some of it may be simple and you're used to it and know it. Some of it may be unfamiliar. We're going to then use some of that terminology to show you how to calculate your profitability in your own business. And then with that profit margin, you're then going to be able to calculate your break-even point. So if those, again, if you're not familiar with break-even point, any of those things will go into it. Next, we're going to cover different types of accounting. We're going to look over some very simplified versions of financial statements, and we're going to look at financial service providers. Today, we're going to go through tracking all the money that's going into your business, and we're going to track all the money that's going out of your business. So these categories are very broad, but we're going to break them down into smaller chunks. Next slide. So the money that comes into your business is generally referred to as your revenue, and the money that goes out of your business are referred to as your expenses. And when you subtract all of your expenses from your total revenue, the money that's left over is what is your profit. That's the money you get to pocket. So usually sales is the money that's coming in. There's an asterisk because sometimes there's interest income on accounts or some other smaller things. But for most businesses, the bulk of money that you have coming in, whether you're selling a product or a service, is going to come through sales. That's going to be your money in, your revenue. And your expenses are your costs, all the ways that money goes out of your business. So now we're going to start to break that down a little bit more. You have money coming into your business, your sales revenue, money going out, your cost expenses. And now we're going to look at your money going out. We're going to break down your expenses. There's two categories of expenses. You have your fixed expenses, and you have something that's called your variable expenses. So your fixed expenses, next slide. Your fixed expenses stay the same regardless of your sales every single month. So it does not matter if you sell more or you sell less. Your rent is your rent regardless of how much you sell. That's a fixed expense. Your variable expenses increase as sales increase. If you sell pies and you make more pies, you're going to need to buy more ingredients. So as your sales increase, so do your variable expenses. A few examples of fixed expenses, I said rent is one of them, but some of the others are utilities, an auto loan, insurance, salaries that you pay, loan on equipments or any other fixed loans that you have. Those are the same every month. And then your variable expenses are things like commission, marketing, your raw materials, your direct labor that's related to making your product or your service or whatever you're doing that's directly related to that, and your shipping charges. So as you sell more, these things go up. So we're going to now look at a fictitious company called Puzzle Mania, and we're going to look at their expenses and revenue and see how can we calculate their profitability. So Puzzle Mania has fixed expenses of rent is $3,000 a month. Their telephone bill is $100. Their insurance is $300. Salaries are $5,000. Internet service is $120 a month, and their utilities are $550 a month. So their total fixed expenses every month, whether they sell $1 or $100,000, is $9,070. their variable expenses are going to be expressed in the form of a percentage, because as they sell more, they buy more. So their raw material costs are 15% of the sales, their wages 20%, credit card fees are 3%, shipping another 3%, and their marketing is 8%. So their variable expenses are 49% of their sales. Puzzle Mania sold 1,500 puzzles in October, and each puzzle was $20. So if we multiply 1,500 times 20, they received in $30,000 in revenue for the month of October. So to calculate their profitability, we're going to subtract both the variable and fixed expenses. So to calculate the variable expenses, we're going to take 30,000 and we're going to multiply it by 0.49, because 49% of the sale is going to be eaten up with our variable expenses. That is going to be $14,700. And we're also going to subtract their fixed expenses. That's $9,070. That's going to leave us a profit of $6,230 on the total sales of 30,000. So to calculate the profit margin, we just divide 6,230 by the $30,000 of monthly sales, and that'll show us, it would show up on your calculator as 0.21, 21% profit margin, which is a very nice, healthy profit margin. And this is just a reminder, especially for those of you that are in business for the first year of your business, you have to think about reserving a portion of your profits in an account, or just know that you're going to be paying taxes on all the profits that come in from your business. So a lot of first-time business owners see money coming in, they've paid all their bills, and they think that that money now is all theirs, and they have to remember that you're going to be paying taxes on that. Next slide. So now we're going to take this a little bit further, and we're going to calculate something called break-even point. This is really, really important to me when I think about what do businesses need to sell, when are they making money, and when are they losing money. So your break-even point is when your total revenue is the same as all of your expenses. So you're not making money and you're not losing money. Your money in is equaling your money out. And there's a calculation for this. You take your fixed costs, the money, the expenses that are not changing, they're the same every month, and you divide it by a contribution margin. Your contribution margin is your price of your unit minus your variable cost. And that's going to tell you how many units or services you need to sell to break even given your fixed and variable expenses. So this might look a little bit confusing, but we're going to go through 3 different companies and just show you, break it down, that this is really not very complicated, but can be very helpful for your business. So we're going to start with Puzzle Mania. We already know their fixed expenses are $9,070 a month. Their variable expenses are 49%. So if we know $9,070 fixed expenses, we're going to calculate our contribution cost. So again, we're going to take the unit cost. We saw that puzzles were selling for $20. We know our variable cost is 49%. So we take $20 and we multiply it by 0.49. That's going to give us $9.80. That's our variable cost. So if we subtract our variable cost from our price, that shows our contribution margin is $10.20. And again, that's taking the unit price that we're selling, and we're subtracting out the variable cost of 49%. So when we're selling a puzzle, before our fixed expenses, we're making $10.20 on that puzzle, but we have to pay our fixed expenses. So to see the puzzles, we're going to take $9,070 and divide it by $10.20. That shows us we have to sell 889 puzzles a month to break even. We won't make any money, but we'll cover all of our costs at that point. So again, to get that calculation, we divide our contribution margin into our fixed costs, 889 puzzles. If we look at that as a dollar value, we multiply 889 puzzles times a selling price of $20, and we see that we need to sell $17,780 to break even and cover all of our costs. That's our break even point. If we sell more than 889 puzzles, we're going to be profitable. And if we sell less than 889 puzzles, we're going to be losing money that month. We're going to look at this same kind of breakdown, but now instead of a product, we're going to look at a service industry. So this is Lulu's beauty salon. She has a lot of overhead every month. Her rent is not inexpensive. Her rent alone is $4,600 a month. She's got $300 of telephone expense. Insurance is $1,200. She pays a manager $3,750. She has internet IT website expenses of $820, and her water and electric are $750. So she has to come up with $11,420 a month just to meet her fixed expenses. Her variable expenses are 2% for shampoo and conditioner. That's pretty low. Her hair dye and perm kits are 7%. She pays her people who work there mostly on a commission basis. So that's going to be pretty high. 45% of her sales is going to go to commissions of her people who work with her. Credit card fees are 2%, and marketing is 4%. So her variable expenses are kind of high. 60% of all the money she takes in is going to these variable expenses. So Lulu service 18 clients a day, 6 days a week. If we multiply 18 clients times 6 days a week, she's doing 108 services a week times 4.3 weeks in the month. And her average service is $120. So if we multiply 108 services a week times 4.3 weeks in the month times $120 average service, she is bringing in $55,728 a month. If we want to look at her profit margin, we're going to take the total revenue, subtract her variable expense, which is 60%. So again, it's multiplying her revenue by 0.6. That's where we got the number 33,437. We're also going to subtract her fixed expenses. So her profit for this month was $10,871. And if we divide 10,871 into her sales for the month of 55,728, we see she has a 20% profit margin. We're now going to do the exact same thing and look at her break-even point. How much business does she have to do to pay all of her expenses and not lose money? We know her fixed expenses are $11,420, and we know her variable expenses are 60%. We're going to take the $11,420 and calculate her contribution margin. So that is $120 times 0.6 to get that variable cost is $72. So again, her variable cost of 60%, we calculate on her average sale, multiplying 120 times 0.6, and we're going to subtract 120 minus 72 gives us a $48 contribution margin. When we divide 11,420 by $48, we see that she needs to have 238 clients a month. If we want to look at the dollar value, we're going to take 200, click one more time, John, please. We're going to take 238 clients times 120 will tell us that she needs $28,560 to break even for that month. That is her break even point. In dollars, it's 28,560. In number of clients, it's 238 clients. If she has more than that, she's going to be profitable. And if she sells less than that, she's going to be losing money. And then we're going to look at one more example. This is Walter's Window Washing Company. He has very low fixed expenses. He works out of his house, and he really has, it's a very good business. His truck lease is $600. His insurance is $150. He has liability insurance for $400. His health insurance is $1,250. His cell phone bill is $100, and his website internet is also $100. So he only has $2,600 of fixed expenses each month. His variable expenses are also, relatively speaking, pretty low. Most of it, a good portion of it goes to gas, getting around. His cleaning supplies are 4%, rags and towels 3%, credit cards 3%, and marketing 4%. So let's look at his general profit margin. Walter can service 2 clients a day, 4 days a week. So if we multiply 2 times 4, he's able to do 8 services per week and 4.3 weeks in the month. And his average service is $300. So if we multiply 8 services a week times 4.3 weeks in the month times $300 of average service, he's bringing in $10,320 a month. We will take 10,320 and multiply it by 0.24. That'll give us his variable expense. So for this particular month, his variable expense was $2,477. We're going to subtract, again, both his variable expense and his fixed expense to calculate his profit. So we see he's left with $5,243. And if we divide that by his total sales of 10,320, we see he has a very healthy profit margin of 51%. But keep in mind, you can't wash windows all day long. The reason he is working on average 4 days a week is he's very dependent on weather conditions. Cleveland, as we all know, doesn't have the most favorable weather conditions. So he has to look at this profit margin, and we're going to look later on about cash flow and managing if there's seasonality to businesses. But if we look at Walter in a good month, this looks very healthy and profitable, but he's also has other things to consider, like reserving some of this money for months where he's not able to get those days and hours in. So let's look at Walter's break-even point. His fixed expense we saw are low, $2,600 a month. His variable expenses also very low, 24%. So we're going to take his fixed expense and we're going to divide by his contribution margin. So again, to calculate his contribution margin, we take his unit average sale price, which was $300, multiply that by 0.24 to get our variable costs at $72. That leaves us a contribution margin of $228. If we divide 2,600 by 228, he needs 12 clients per month to break even. Then if we look at that in terms of his dollars in, we're going to take 12 clients times his average cost of $300 and see that $3,600 will cover all of his expenses for the month. That's called his break-even point. So if he has more than 12 clients and sells more than $3,600 in services, he's going to be profitable. And if he sells less than that, he's going to be at a loss for that month. So many of you, I hope, are thinking, wow, that's really useful information. I'd like to do this for my business. And certainly all of you can do this for your business. If you have, the easiest way to do it is if you're using any kind of accounting software, QuickBooks, FreshBooks, Peachtree, any kind of accounting system will have this information that you can use to calculate both your fixed and variable expenses. If you don't have an accounting program, it's not a problem. You can still get this information. You're going to want to collect all the data around your revenue. So that can come from bank statements, point of sale systems, paper receipts, Square, Venmo, Cash App, Zelle, if you're on Shopify, Etsy, Amazon, Poshmark. But basically, by looking also your bank statement, hopefully everything is going through a business bank account that you can look at all of the revenue coming in to get a good idea of that side of the equation. On the expense side, you're going to want to collect bank statements, look at all of the bills that you've paid, and then either you can ask, if you don't have a score mentor, you can get a score mentor that can help you break down what are variable expenses, what are fixed expenses, and then getting information around all of your expenses. You can look at your bank statements, your checkbooks, any paper invoices, vendor account history. I think this is a really nice one. If you have some vendors that you order regularly, but you're not on top of all of your accounting and bookkeeping, you can call and ask that vendor, can they give you a statement for year-to-date purchases? Or can they give you records of purchases that you've had so that you can collect and get a good idea about what those expenses are? Your credit card bills, your employee payroll, and any 1099 contractors that you might be employing are all places to collect that data. I did see there was a question of how do you figure out the percentage? And the easiest way to figure out the percentage is to look at your history and your data around it. So as an example, Lulu's will look up, she can look at last year as an example I like to look at an entire year and then divide it up, because sometimes you might buy shampoo and it could last you for 4 months, or it could last you for 2 months. So if you can collect the data and look at it at a year's time, then you can see, based on your revenue, how much shampoo did I buy, or how many rags did I buy for my window washing company. So when you have all of this data collected, you can look at it and break down and see, based on your sales, what amount of money did you spend, and that'll give you a percentage. Are there any other questions before we move on from this part of the session? Okay, great. I think we're ready. John, to take it away.
Whoops. Okay. Good evening. I appreciate having a chance to talk with you this evening. I'm going to build on what Chris has said already and talk a little bit about stepping back a little bit into accounting. And there are really two types of accounting. And what Chris has been describing are really the basics of financial accounting, which is looking into the past. It records transactions that have already happened, past. Accounting has very strict, as you probably know, very strict formats and conventions. That's why they've got specialists to do that kind of work and specialized software. Accounting records have to withstand audit, as you can imagine, because your financial data goes to file your taxes, and it has to balance perfectly. It has to be able to be reviewed. Usually done by an accountant or other provider, or by software. But those are the rules, and it's, like I say, it's very backward looking. I'd like to introduce a new concept called managerial accounting. And this is kind of the same tools that we've been talking about also, that Chris has been building on, only this is taking the data and trying to forecast your future performance. And to the extent that you have past record, you need to look at what's happened in the past, look at the future, look at what's going on in the business as a whole, what's going on in your community, how you think, what factors will make things go up or down, and then it's like driving a car at night. You need to turn on your headlights so you can see what's coming. So it's a little bit what managerial accounting is. Managerial accounting is simpler in terms of formats. You're still using the same formats, but you're focusing now on again, looking into the future, and it's got to be consistent with the financial data. Otherwise, you can't take your past data and project it forward. But you're not focused on forms and formats as much as you are the quality of the data. And managerial accounting has to be realistic. It doesn't have to withstand an audit. It's like trying to audit a crystal ball. There is no working crystal ball. But any stakeholder that looks at your forecast, they're going to be looking for realism. Does it make sense? Does it square with their understanding of the real world? So that's the watchword for managerial accounting. And managerial accounting is really the responsibility of the owner of the business. They can get support from an accountant, provider, or sometimes software can help you to do that as well. But managerial accounting is taking those same tools and using them like as close as you can to a crystal ball. So financial accounting produces information primarily for others. You use it too, but it's primarily it's produced by accountants, bookkeepers, or the software. Helps with any stakeholders. So if you're looking for a lender to borrow from, or you're maybe an investor, or you're looking to form a strategic partnership with another company, they'll want to see your financial, your past record for sure. Managerial accounting produces information mostly for you, and really is a tool to build a financial model for your company. So this hasn't happened yet. You're trying to model what's going to happen in the future. And we're going to talk about the dimensions of that model in a minute. Forecasts, necessarily, if you're starting a business, you don't have any past data. So you're starting out very rough, and you can figure out a lot of your expenses by pricing your supplies and your equipment and things like that. Forecasting your sales and your revenues can be very, very tricky at the very beginning. And it is one time when assumptions are a good thing. You don't have data, so you have to make assumptions. And you make the best assumptions you can, the most realistic assumptions that you can, but you use that to build a model. And if it gets rough, it gets better as you get more actual data. Doesn't mean there won't be surprises out there. You try to look for those as best you can, but it does get better. And you can use spreadsheets, you can use graphs, you can sit down with a piece of grid paper and lay these things out yourself. It doesn't have to be, you don't have to have computers, although they do certainly help. And certainly, if you've got accounting software, to the extent that it can help do your forecasting for you, use it. But you need to understand the basis of how the software is operating so that you know how realistic those forecasts are. So from now on, we're going to be talking mostly about managerial accounting. There are three standard statements, and as you've noticed already, this is not an accounting course. This is we built this course for the layman. I've never had an accounting course in my life, but I've sort of picked it up over the years. But basically, accounting has three chief statements. One is a profit and loss statement, and Chris has given you the basis for that in laying out the expenses, revenues, and expenses, the two types of expenses, fixed and variable. But also another statement called cash flow. Again, you take your money in and your money out, but you look at it in a different way to try and figure out how your checkbook's going to look in the future. A third standard report, we're not going to elaborate on it today. It's basically a balance sheet. And if you've ever done your household net worth, where you sit down on a spreadsheet or a piece of paper and you put down all the assets of your household and all the debts and liabilities, and you subtract that, and you get either a positive number or a negative number. That's kind of like a balance sheet. The only difference is in business, a balance sheet has the assets on one side, the liability side has the debts and obligations, and then it has another part, which is the equity of the owners of the business. And so those two will always balance out, because when you subtract the two, everything else is equity. And you want to, of course, it's a snapshot in time. A balance sheet isn't a long-term thing, but every so often you look at that. Hopefully your business is going to tell you how much your business is growing, how your equity is growing. So we're not going to go into that, any examples or anything, but those are the three big reports. So these statements do a lot of things. As I said, they help you to prepare your taxes. They produce information that potential lenders or investors or strategic partners might want to see. Help you predict the future of your business, again, by creating the financial model. Also helps to gauge the health of your business. This is a little more subtle. When you're managing a business, you need data to help you, especially as you grow, and that includes financial and non-financial data. And this is kind of the core of strategic planning. So profit and loss statements, which is really what we're building the framework for, sometimes called income statements. They use the data on revenues and costs to determine your current profitability. That's financial accounting. That's looking back in the past. Shows how profitable your business is likely to be over time. That's managerial accounting. Now you're turning your headlights and looking at what's ahead and trying to figure it out. Helps to prepare your taxes. That's financial accounting. That's looking into the past. It demonstrates to potential stakeholders that you have a realistic path to profitability. That's a little bit of both, because you'll have your past records of your profitability, but also you'll be projecting the future. And so potential investor or lender or strategic partner is going to be looking, how's your profitability been so far? How realistic are your profitability projections going forward? And that's so they'll be looking at really the products of both kinds of accounting. Likewise, as you get really good at this, you want to do other things, fancier things. You want to be able to pinpoint excessive cost, unprofitable product line. And here you're looking at your data, both past and your projections. In the past, you're going to be looking for these kinds of things to improve your profitability. Also, it might be doing okay now, but maybe you can see some changes up ahead, and maybe you can see that your business isn't going to perform well enough for some new challenges. That's the managerial part. You're looking ahead and yeah, it's been okay, but it's got to get a lot better to meet new conditions. So really you're using both kinds of accounting. Cash flow statements also use money in and money out. It displays it just a little differently, and it really is a way to. Cash flow is important because cash flow can sink your business faster than the lack of profitability. You can't pay your personnel, you can't buy supplies, you can't operate, and you're circling the drain. You also, as we saw with Walter's window washing, there's seasonal fluctuations in sales in some kinds of businesses. You need to look at that ahead. Again, you need to get out there with the crystal ball and look for when are your busy seasons, when are your slack seasons, and plan to have enough to be able to stay alive through all of it. So a cash flow model, remember we're using that word model, again, that's kind of the key word, the watchword in managerial accounting. It's a model that enables you to view what your checkbook will look like in the months ahead. If you're going to make a major purchase, you want to figure, when am I going to have the money to make that purchase? And how am I going to pay for it? Cash reserves. You want to keep a cash reserve in your business big enough to handle foreseeable emergencies. But if you put too much in the bank, interest rates are a little better, but they're still not very good. And you want to put your money to work. So you want a reserve that's big enough but not too big. And again, using your cash flow to make forecasts of how much money you're going to need to operate helps you to right size your cash reserve. Also, again, if you're talking to potential lenders or investors, they see that you not only have cash flow records in the past, but you're projecting into the future. They got to gives them more confidence that you've got a realistic view of your cash resources and you know how to manage. So there are all kinds of financial service providers. At the simplest level, bookkeepers usually have an associate degree or higher. They record financial transactions. They do basically financial accounting. And the individuals who are bookkeepers might be able to do more, but you can't expect that of them necessarily. An accountant has a Bachelor of Arts or higher degree, and they can interpret financial information and give advice. So they can venture and help you to venture in, even though it's your responsibility to do managerial accounting. They're trained to help you in doing that and give you new insights from their vantage points. A certified public accountant can do everything an accountant can do, but also they've passed an examination. They're licensed by state, so you've got a bit more of assurance of professionalism and competence at that level. So whatever level, and of course, in addition, there is obviously the software that does all that. Plus, there are special purpose applications and specialists. There are payroll services, there are tax preparation services, all kinds of services that do specialized tasks in the financial world. So looking at projections and kind of merging, making sure that your two things are in sync. Remember that projections aren't just a one-time effort that you do just to get a business loan and then you forget it. You need to keep your headlights on as you're going forward to see what's coming. There should be some continuity between your financial projections and your ongoing tracking. So you need to be using the same buckets of that you put your costs and your expenses in and your income. If you're using an accountant, sit down with the accountant or bookkeeper, show them your projections, make sure that you're using the same categories, that you're using the same methodology, that you agree on what's fixed cost or variable cost. And those things, there are things that are purely fixed and purely variable. There are costs that can be influenced a little bit by volume, and you got to figure which bucket to put those in. An accountant's a good person to work with on that. If you're using accounting software, make sure that you understand its financial reports, how they behave, and as you're projecting, and if it has the utility to project, make sure you understand how that works. If not, contact their customer service to get a good idea of what that software can do for you, what you have to do yourself, and how you can use the past records to accurately project into the future. So you know something about how the past numbers were generated to do that. So the watchword here is just continuity, because accounting is accounting, but it's how you use past versus your future projections. Now, going a little further, and again, I'd mentioned my background when I was years. Part of it was in quality assurance. So I'm very, very focused on process health and quality. Um, uh, the basis for any accounting system is something called a chart of accounts. And a chart of account is just a list of the buckets that you put your revenues into and your costs into. And those are pretty much standardized, and Richard's helped me understand that a little bit. They're standardized by industry, and a lot of industry associations have standard charts of accounts you can get. The difference is how finely you divide up those buckets. The more detail you get, the more finally you slice your data, the more insight you get, the more information you get. But you got to balance that. There's a cost benefit analysis. It takes time and sometimes money to slice the data very, very finely, but there is a benefit to it up to a point. So you can sit down with an accountant or other financial service provider and figure out the degree of detail you want to gauge the health of your business and make good decisions versus when you've got busy work. You want to find the right level of detail. Now, once you've got a chart of accounts, it looks good, you've got the right number of categories, and you're looking at the right things, then you need to sit down and quiet time, review your financial statements and reports from the past, looking for trends and anomalies. Look at your projections. They still look realistic. And that can be either good or bad. If results are unexpected, even good things, you probably need to drill down into the data to find the causes. If it's something bad, you want to fix it. If it's something good, you might want to use leverage that and maybe bottle it and use it in other parts of your processes. So whatever you learn that's different from the past, take a look. You can use data and we'll talk about this in the second session, help you identify your most profitable product lines and those that aren't so profitable. Think about how to improve profit. Identify your most profitable customer segments and those are less profitable, so you know which ones to focus the most on. Diagnose potential problems, whether they're quality problems, production problems, something comes up from the outside. Look at your data because that's the surest map to finding answers to those things. And finally, we've got a glossary of the terms that we've been using in the session today. And when you get the copy of the slides, you'll have this, but these are all the terms that Chris has used in her review. So this is, I think we're down to the point of questions now. And let me stop sharing my slide. And in our next session, before we open up questions, we're going to actually take these concepts. We're going to play around with some formats, some simplified formats, and try our hand with Puzzle Mania and Lulu's. And we're going to practice, going to play with it, and see if we can't diagnose some things together. So at this point, let's open up for questions. Let's see, we have some in the box here.
Here's a question on how do you structure the data to separate where the revenue is coming in?
Yeah, you can. You can. Here's where you can decide. Do you want to divide your customers by segments? If you're selling to residential customers and also maybe to other businesses and maybe making some sales on the internet, you can segment those in break them down and see how each of those segments behave and their spending patterns and use that to maximize profit. And again, how finally you break it out, there's a cost to it. You got to work with your financial service provider and see what's the right level of detail.
I don't see any other questions. I realize there's a lot of information today, and I will point out that if you find it confusing, you can sit down with your mentor and go through all of these issues, and your mentor will help you understand what all of the reporting is and how to do your cash flow and other things. So if you don't have a mentor, please go to our website, www.score.org/Cleveland. You can sign up for a mentor and they will be happy to help you with this information. So Chris and John, thank you so much for the presentation tonight, and Richard. And as long as there don't seem to be any further questions, I think we'll call it a night and say thank you very much and enjoy the rest of your evening.
It's been a pleasure.